The stock market bubble that I spent the best part of 2021 telling you all about has already started to collapse, but you probably knew that. You've probably noticed that the S&P 500 is falling. You've probably noticed that Netflix has seen its value drop by 70%, that Facebook has had its share price cut down by over 40%, and that almost every single industry has been hammered throughout 2022. What you might not have noticed though was that this was all very predictable, and not just by me, but by many other far more accomplished, successful and wealthy investors. One of those people who warned us about the state of the markets, who warned us about lofty valuations and the likelihood that we'd see those valuations crater, was of course Ray Dalio. The really interesting thing though is that despite the fact that he pushed out his views, that he tried to warn us all about what was happening, the vast majority of people heard him, but they just ignored him. To be clear, they didn't disagree with what he had to say. They didn't claim that the statistics or facts that he used were false, they just refused to pay attention. They buried their heads in the sand, and when the market started to tank, they lost an awful lot of money. Well, Dalio is back today telling us all about his views on the market once again, and this time I'm determined to ensure that everyone is at least given a chance to reevaluate their investments, to consider their risk tolerances, and decide based on intrinsic realities and not emotion where they should invest their money. Today I'm going to take you through everything Dalio has to say so that you can't claim ever in the future that you were never warned. Now firstly, Dalio goes through and explains exactly the criteria that he uses to determine whether or not there actually is a bubble. High prices relative to traditional measures of value, for example by taking the present value of their cash flows for the duration of the asset and comparing it with their interest rates. Number 2. Unsustainable conditions, for example extrapolating past revenue and earnings growth rates late in the cycle when capacity limits mean that the growth can't be sustained. Many new and naive buyers were attracted in because the market has gone up a lot, so it's perceived as a hot market. Broad bullish sentiment, a high percentage of purchases being financed by debt, and a lot of forward and speculative purchases made to bet on price gains, for example inventories that are more than needed or contracted forward purchases. Dalio then goes on to explain what the situation was back in January, before he compares that to today. In January, the bubble indicator showed that the US equity market as a whole was at the edge of a bubble, but not in an extreme bubble, for it was 70% of the way towards the highest bubble, which happened in the late 90s and the late 1920s. And B, the emerging tech companies like Tesla and Roku were clearly in an extreme bubble. I also noted that other bubbly behavior like SPACs, the IPO boom, and the big pickup in auctions activity, financed by the unprecedented flood of liquidity post-COVID, had found its way into the asset markets, making things bubbly. I showed which stocks were in bubbles and I created an index of those stocks which I called bubble stocks. Now, investing in stocks should never be emotional. 66% of investors report regretting making an emotionally charged investment decision, and with stocks crashing almost every day, I'm certain that number is only going to get worse. That's why over $1 trillion is managed by institutions who use rules-based or quantitative investment strategies to remove human biases. But in order to build your own quantitative strategy, you need to know how to code, be a master at Excel, and pay for expensive trading software until now. Composer is an automated trading platform that allows investors to seamlessly build a portfolio of rule-based strategies called symphonies, no code or spreadsheets required. Take a look at this symphony that I personally built called the Stoic Finance Inflation Spiral Hedge that has so far beaten the S&P 500 by over 25% across 2022 by focusing on soaring bond yields, commodity price inflation, and consumer staples as opposed to just buying tech stocks that keep falling in value. I'm really pleased to see this symphony continue to outperform as the rest of the market is crashing. The best part about all of this is that it's completely free to use. You can gain access to this game-changing super app free of charge, and for a limited time only, my subscribers can earn $100 for free when you invest in a symphony by using my exclusive link in the description. Also make sure to check out the disclaimer and special terms in the description too. So if the idea of creating your own mini hedge fund strategy sounds appealing, or if you want to invest just like I do, then make sure to click the link down below in the description and claim your free $100. So Dalio was pretty sure that there was a bubble in the overhyped tech stocks, and today in mid-2022, it's safe to say he was right. Roku is down 82% from its all-time highs, Shopify is down 75% from its all-time highs, and DocuSign is down 74% from its all-time highs. Cathie Wood's ARK-K fund, which came to perfectly encapsulate the hype stock bubble and is even basically used as an ETF of just overhyped junk, is now down by 64%. The reality is that this is seen with almost every single tech stock that rose such a ridiculous amount over the prior 2 years, that was valued on future revenues that were never going to be seen and theoretical margins that were purely figments of venture capitalists' imaginations, and Dalio recognized this as well. Since then, those bubble stocks popped. They declined by about a third over the last year, while the S&P 500 is about flat. With those and other developments in the market, like the meaningful decline in frothy retail activity, the meaningful deterioration in sentiment, and more, the emerging tech stocks no longer appear to be in a bubble, but neither do they appear to have substantially swung to the opposite extreme, so it's not necessarily true that now is a good time to buy them. So that was actually quite clear. Yes, those stocks were in a bubble. Yes, that bubble has popped. But no, they are not going to stop declining in value. Dalio also goes some way in saying something that I bring up quite a lot, that bubbles don't really pop, they deflate. Bubbles can take a long time to unwind, 2 years in the case of the 1929 bubble, 1 year in the case of the late 90s tech bubble, and typically go in the opposite extreme. So just because they aren't at a bubble extreme doesn't mean they are safe or that it's a good time to get long. In fact, US stocks in aggregate still look overvalued by our measures. History shows that once the popping begins, bubbles more often overcorrect to the downside versus settling at more normal prices. Dalio then gives us a few charts that show us how we're not actually that far into the end of this bubble and that there is probably more pain to come. Back in the 1920s, the bubble that caused the Great Recession went from almost 100% on Dalio's measure all the way down to 5% at its lowest point, representing those frothiest of all stocks, falling in value until they are worth just 1/20th of what they used to be. During the dot-com bubble as well, we saw a very similar thing. The bubble gauge that Dalio created shows stocks falling from nigh on 100% down all the way to around 15% at its lowest, meaning that stocks were worth just 1/7 of what they once were. Today, where do we sit 4 months into 2022? Well, sadly, we are nowhere near those sorts of levels. While Dalio's gauge never got quite as high as it did in the past, it is also nowhere near as low as it's gone in the past either. Right now, we're sitting at around 40%, and that means at the very least, we are probably only halfway done, meaning another 6 months of consistent declines in the market, week by week and month by month, and the frothiest of all stocks out there, the bubbliest of them all, that were valued on nothing but thin air and hope, well, they are still likely to be cut in half again. Now, what you should really be asking right now is what on earth is this bubble gauge that Dalio keeps referring to, and just how does it work? Well, luckily enough, Dalio goes on to explain just that. He gives us this table here with his 6 points and states whether or not he thinks each of those is in a bubble, not in a bubble, frothy or deflating. Very clearly, the 1920s bubble that caused the Great Depression was a bubble across the board. The dot-com bubble was a bubble as well, and back before we saw this sustained market rout as 2022, we were in a bubble too, though according to Dalio, it wasn't as bad as it had been in the past. As of today, compared to traditional pricing measures, stocks are still relatively high, but they've taken a major hit. The simple fact is that if we go back to 2021, where tech prices were ridiculously high, seeing a company with a PE ratio above 100 wasn't rare or anything special. Only when we saw crazy high PEs of Tesla sitting above 300 did people start to recognize that maybe there was a bubble in the pricing of tech stocks. But even then, there was and there still are vehement defenders of Tesla's share price who claim that it's actually undervalued. The next point on Dalio's checklist is, are prices discounting unsustainable conditions? And the simple fact is, yes, they were back at the peak of tech prices in 2021, and actually, they still are today. The best example of this, in my opinion, is SaaS, or Software as a Service companies, who have seen ridiculous valuations recently because investors love recurring, reliable income. The problem is that these companies also tend to have very strong margins, often above 30%, because they sell software that has a marginal cost of almost zero. The problem with this way of thinking and valuing things, though, is that any industry where margins are 30% is going to have huge competition, with everyone and their mum trying to get in on that cash. As a result, over the long run, once these markets have become fully saturated, the price that these services will be able to charge will fall and margins will fall as well. A brilliant example of this is the 100 different online contract companies like Signable or DocuSign, who all provide an identical product. Once every company has signed up with one of these companies, growth will slow and stagnate, and prices will be forced down by the huge amounts of competition because there is simply no difference between the various online contract companies. Next, we have how many new buyers are entering the market. Now, this is another area where the bubble gauge was screaming at us, as Robinhood, Coinbase, and Cheap Capital has led millions of people who normally had absolutely no interest in investing at all right into the markets and into the riskiest parts of the markets too. In this sense, we have seen a collapse of new entrants to the market recently, as you might expect with prices falling week by week and month by month. But in reality, there is still a lot of downwards action to be seen, and Dalio doesn't think we've hit the bottom here either. For number 4, we have how broad is bullish sentiment. And here the contrast between what we used to see and what we see today is huge, as there has been a total capitulation in bullish sentiment. If you think about how bullish people were back in early 2021, when tech stocks were booming and stock picking monkeys could become millionaires, compared to today with permabulls like Meet Kevin panic selling, the change is monumental. Number 5, and one of the most important and dangerous metrics here, is are purchases being financed by high leverage? And while it did get really quite bad, the amount of margin trading we saw back in 2021, this gauge has started to drop off. As we still sit though, and especially in the very volatile markets of crypto, NFTs and tech stocks, there is still far too much margin in the markets. The reason this is so dangerous is that too much leverage in the markets leads to positive feedback loops where declines in asset prices lead to liquidations, which then in turn cause asset prices to fall further and then more liquidations come. In this measure, there is still an awful lot of leverage that has yet to be closed out that I expect to see disappear before the markets actually hit their bottom and we see a bull market emerge. Finally, we have to what extent have buyers made exceptionally extended forward purchases. Now, what this basically means is people, investors or businesses are being too optimistic about the future, and for this measure, actually things aren't too bad, and they haven't been too bad for years really. This reflects whether or not businesses are expecting the strong demand that exists today to continue long into the future. And while this measure could be higher, it could also be far lower, and before the market bottoms, we should be expecting this to reduce further too. Now, it is clear that Dalio thinks we used to be in a bubble and that the bubble has already started to deflate, and I wholeheartedly agree. I imagine then that there are some people watching this who are about to go and throw their life savings into the market because some of those measures were actually quite reasonable, so asset valuations must be reasonable then too. But to those people who might be thinking or feeling that way, I will caution you to listen to something that Dalio said earlier, that when these bubbles deflate, asset prices don't simply return to normal levels, they overcorrect until they are grossly undervalued, and then they begin the slow march back up to reasonable levels. There are many stocks out there that when you look at them alone, they seem like brilliant deals. Facebook is very appropriately priced right now. Google and Apple are basically legal money printers at this point. And were this a normal market cycle, I would probably be buying into those companies right now. But this is not a normal market. This is a tightening market where interest rates are rising, where the Fed will be selling bonds in a month's time, and risk sentiment is deteriorating every single day. There is nothing to suggest that the bleeding has stopped. There is nothing to suggest that even these great companies at these great prices won't see consistent declines for many more months into the future. Personally, I don't even think we're halfway done, and the only thing that can really turn everything around right now is the Federal Reserve and Jerome Powell truly throwing caution to the wind, ignoring inflation and turning the money printers back on to save his precious asset prices. Until that happens though, a bear market is far more likely than a bull market. Now, before we sign off, I want to make one thing very clear. I do not like Ray Dalio. I do not think he's a good person. I think he is corrupted by money, and his willingness to ignore the Uyghur genocide purely because it makes him more money is utterly shameful. But that doesn't mean I'm going to ignore everything he has to say. The simple fact is that he is one of the most successful investors and businessmen the world has ever seen, and anyone who refused to listen to him simply because he's a bad person is dooming themselves to failure. We don't have to agree with him, we don't have to like what he has to say, or even heed his advice when it's given, but at the bare minimum, we should always listen because there is a chance that we learn something truly groundbreaking. I'd also like to give one final thank you to this video's sponsor, Composer. If you want to invest like I do and beat the market by over 20% while stocks continue to fall, then check out the links down below. The markets have never been harder to navigate, and having a clear, concise strategy like mine that involves no emotion can be hugely important. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm and help the channel out. Also, make sure to check out our Patreon and join our exclusive community of investors where we discuss everything about the markets and you get exclusive private access into my portfolio with buy and sell alerts for all my own investments. There's a link in the description to Masterworks which can help you protect your portfolio against market crashes through fractional shares of art from world famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets as bad as they are. Finally, there's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. It's literally free money, and you can earn interest on your crypto there too. Thank you all for watching, stay stoic, until next time.